Good afternoon and welcome to Biztech's Asian Midday Market Watch. I'm your host, Jeffery Halley, and today it's Wednesday, the 25th of September. Our guest today is Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, welcome to the show. Unusual to see you here on a day that's not Friday.
Yes. So today is a midweek day for me for this week. Yeah.
Well, we'll leave Kelvin up today because I'm flying solo. Let's just go through the summary of market actions overnight. It was a busy night on Wall Street. The S&P 500 and Dow Jones ended up at record highs, and that was mainly driven by US consumer confidence data, which was very weak, but also on the other side of that boosted hopes of more outsized rate cuts to come from the Federal Reserve. And that followed also from a raft of stimulus measures that were announced by China yesterday. The Dow Jones Industrial Average rose 83.57 points or 0.2% to 42,208.22. The S&P 500 rose 14.36 points or 0.25% to 5,732.93. And the Nasdaq climbed 100.25 points, or an impressive 0.56% to 18,074.52. Overnight data showed US consumer confidence unexpectedly fell to 98.7 for this month, and that was from an upwardly revised 105.6 in August. That was the largest decline we've seen actually in nearly 3 years. The odds of another 50 basis point rate cut climbed overnight as well, with the CME Group's FedWatch tool now predicting a 60.4% likelihood that there will be a 0.5% rate cut by the Fed in November. Gold and other metals were boosted by the China stimulus measures, and gold itself finished the overnight session at 1.1% higher at $2,658 an ounce. Currency markets also saw plenty of action as the stimulus measures from China made their way through the market. Those measures pushed the yuan higher, and also the Australian, New Zealand, and dollars, as well as sterling. The dollar index slumped by 0.55% to 100.35 overnight, and it's edged lower to 100.25 in Asian trade as that weak US data we saw overnight continues to weigh on the US dollar. Let's take a look at what's happening in stock markets around Asia now. Unsurprisingly, given that the PBOC has announced yet another rate cut this morning that we will be talking about shortly, Shanghai is 1.96% higher today, with Hong Kong's Hang Seng rising by 1.97%. In Japan, the Nikkei 225 has eked out a 0.14% increase. In Australia, stocks are flat. The ASX 200 is unchanged on the day. In South Korea, the Kospi is down just 0.17%, a quietish day there. Singapore is down 0.64%, while Kuala Lumpur is down just 0.18%. Now let's chat to Kelvin, our guest today. And I guess the first question I have for you, Kelvin, it was a pretty busy session across multiple asset classes overnight. Can you talk us through those moves in stocks and FX and metals such as gold on Wall Street overnight?
Sure. So maybe let us focus on the clear winner will be gold, XAU/USD. So very clearly we see gold surging to another fresh all-time high in overnight and today's Asia session, hovering around about the 2,660 level, 2,660 level per dollar on a quarter in dollar terms. So what we could see over here is that it seems to us that for sure the longer term of holding costs, opportunity cost of gold has indeed remarkably declined further after that potential 50 basis point cut that could be enacted in the November FOMC meeting as being priced by the latest short-term interest rate futures contract in US. specifically that earlier as being calculated by the CME Fed Watch 2. So the thing about this situation in gold over here, it seems to us that it's, I think, as a form of a hedge, just in case that the global economy slip into a recession, which US itself potentially it could be, given the fact that we cannot ignore the fact that several growth-related economic data in US is getting more lackluster than rosy. As we mentioned earlier in our show, that consumer sentiment from conference board has started to indeed turn weaker unexpectedly from the data print yesterday for the month of this year. So something to be keep an eye watch for. Then now the next story about coming from China point of view. So we recall that China right now, the current newly appointed central banker is now taking a tea leaf from Super Mario Draghi of whatever it takes, mantra to actually hopefully to save the Chinese economy. And do not forget that I suspect is being pressured to do so because of that 5% psychological annualized yield target that's been trying into the market participants' mindset, which is very unlikely to meet by the end of this year if there's no forceful stimulus measure that's being ignited. So we see a slew of simultaneous interest rate cut announced yesterday by PBOC. That also actually causes the China 10-year, we call it sovereign bond year, to actually inch down to record low as well. And do not bear in mind over here is that fixed income investor in China investing bonds at this low level, definitely for sure there's not so attractive as per se. And given the fact that there's also a warning from PBOC is that they're actually watching this very low depressed bond yield by market forces to push it down lower. So at any point in time, they may just come in and slow down the pace of this rapidly declining Chinese sovereign bond yield trend. So in terms of bond investor, if I were to pick up bonds at this low level and there's a risk of smoothing operation by the authorities, I may not get the desired maximum capital gain. So potentially, right, this flow of money could start to flow into gold as well. So Chinese investors perhaps will be another source of potential inflow for gold in the months ahead. So something to keep a close eye watch for in this particular market.
Right. I'm looking at the stock markets today, and obviously the China markets and Hong Kong is included in that have performed very, very well. But there's been a pretty muted response across the rest of Asia and or ASEAN in general. Are markets just pricing this in as a temporary sugar rush for China? And are they worried about its longevity? Because I note that the PBOC cut its 1 year ML left rate this morning as well by 30 basis points.
Yes. So I think market now is trying to digest the euphoric rally that was taken shape yesterday. So market is now looking at very close extensions that would there be a risk of a liquidity trap scenario unfolding in China? So basically, what's this liquidity trap? Yes, we start to see very, very strong accommodative monetary policy, like open up the water type or the water floodgates wider and wider to see a flush of liquidity flowing into the Chinese economy. And this liquidity trap scenario will take place is that nobody in China or very little people in China are willing to take up this extra liquidity to purchase productive, we call it resources like loans for housing loans for business corporation, business fixed capital outlay investment. All right. So the reason about this over here is that because there is no accompanying aggressive expansionary fiscal policy at this juncture. So policymaker from the fiscal side is pretty much silent. So far what they do over here is that they have some scheme to introduce kind of a trade back of a old electronic appliance. So they can actually bring their old appliance, trade it off with a new appliance, you see. So rather than a direct voucher, which some of the westernized major economy did during the COVID recession period, where they gave out direct cash vouchers in a way for consumers to directly spend on the necessity. And this juncture, China government is not willing to do that yet, stating the fact of that there may be risk of a welfare situation. But the problem over here is that due to the very weak housing prices and everything is linked to the property market, so unless they come out something very, very directly impacting the property market by really buying up more homes, but that could actually derail China long-term plan because they do not want to use the property market or anything related to the infrastructure to the property market to boost GDP growth again, because that will actually cause another round of bubble in the property market that causes this very, very weak internal demand situation when the property market bursts. So I suspect market participants want more direct kind of physical spending that is directly to the social welfare of the consumers. So that potentially could come out because next week in China, we do have that National Day long weekend holiday starting from next Tuesday all the way up to Friday. So tomorrow and next day on Thursday and tomorrow, there could be a chance of a monthly top level key stakeholder meeting. That means the top policy, leadership meeting of the China policymakers, because the political bureau meeting. So perhaps we could see some form of, hopefully, I hope that we may see some form of more forceful stimulus measures to come into play. So that's why I think we are looking at market participants from the stock market perspective are holding back their guns after that 4% to 5% rally that's been seen on the benchmark.
Right.
Enhancing versus yesterday.
Okay, so we're not quite at the Draghi-esque big bazooka yet. Kelvin, looking ahead, you've mentioned the holidays in China next week, but what other event or data points are you going to be watching this week?
Yeah, so for sure this week will be primary focus on a slew of Federal Reserve officials speaking, Fed speak. So on Thursday, we do have the boss himself, Fed Chair Powell speaking as well. So market participants will be skewing very close attention to his tonality about the state of the US economy, especially yesterday's much more lower than expected Conference Board consumer confidence data. And also lastly will be on Friday, the US PCE inflation data as well will be utmost important. So hopefully market participants will be looking at this slow deceleration inflation trend in US that could actually support this ongoing US interest rate cut cycle that had just been kickstarted this month. So any big surprise for sure will actually cause another round of high volatile movement in the US market, especially in the stock market itself.
Okay, so I guess the underlying theme is we won't be bored in Q4 of 2024. Kelvin, thanks so much for joining us today.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at Oanda in Singapore on Biztech's Asian Midday Market Watch. I'm Jeffery Halley, and be sure to tune in tomorrow and on weekdays in general at 1 p.m. for the latest market updates. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it with our syndication partners, TV stations, radio stations, and websites. Remember to like and subscribe, and thanks for tuning in today.